Testing 1, 2. Hello, hello. Okay, fantastic. Everybody's on track. And we will get the show on the road. First of all, let's see how things are going. Poor MP Materials, because they, they have the U.S. rare earths, and because we did the deal with China, and China's going to start shipping rare earths again, they went down. But it's stupid because the background intent is still there to have U.S. companies catch up on rare earth materials. So they will get a lot of support over the next couple of years regardless, because you still want to get away from this dependence on China, where China has the ability to cut off our manufacturing capabilities. Not only that, though, but if you consider, what if it's a military conflict and China just says, oh, well, you've got the planes and the computers and stuff that you have now, but that's it, because we're not going to give you any more materials to make them. We're ridiculously dependent on China for our advanced technology. I mean, there's really not much we can build without magnets and rare earths. I mean, it's an insane concept. Yeah, I mean, I guess we can go back to whatever we did, before, but so we can make like 20. Yeah, well, actually, I mean, if you want to see how that works out, like building with the old technology, look at what the Ukraine's doing to Russia. You're not going to get very far if you start like trying to put your military together based on, 1980s technology. Wait, maybe this is good. Something's happening. Okay. All right, that should start up in a minute and we'll be in good shape. But meanwhile, we were looking at this screen, not that screen. The modern theme. No, thank you. I do not like change. So indexes be looking like this. S&P went all the way up to 60, 60, 60, 70, whatever on the spike. We had a huge spike there. It was insane thing. That was when the CPI came out from 42.8 to 43.2, 400 points in like seconds. Based on nothing, really. I mean, there was not really, that CPI report was not that exciting. I'm not even going to get into it. But I mean, it was the kind of thing like, well, airline tickets are down, but food is up. It's like, it doesn't really balance out for the average person. And that's what's crazy about the CPI report too. They get, it takes into account things that don't help you live from day to day. And so for the average American, for the bottom 80%, they care about the cost of food, and energy came down actually, but it's back up. And that's the other thing when you look at a CPI report and it says, oh, look, energy costs came down. So we look at gasoline, of course. So yeah, in March, gasoline, look at gasoline. So in March, gasoline was way up here. So let's say the average is here at 220. And then in April, we plunged to 195 or whatever. And we really topped out in April at 210. So let's say it averaged $2 in March. That's 10% less. So your energy cost went down 10%. But that doesn't put food on your table. And it doesn't really balance out because, you go to the grocery store and it's $200 a week, right, for a family, at least. And I'm talking about like, not a wealthy family, but they're going to spend a couple of $100 a week on groceries. To go to the grocery store in their car, maybe they're going to drive, let's even say that a person drives 1,000 miles a month, right? So that's fair. So 1,000 miles. Now you would have spent, let's say it was 360. Oh, that doesn't work. 1,000 miles. I'm sorry, it's 1,000 miles in a month divided by 30 miles a gallon. So you would have used 33 gallons in a month times 360 is 120 bucks, right? Versus what was that number? 1,000 divided by 30 times. So instead you spend $3 a gallon, and that's 100 bucks. So you're saving a grand total of $20. And that obviously, so you're spending, why did I do all that math? You're spending a grand total of $20 when gas price goes down 10%. So you have in the CPI, that's equivalent, but food, which you spend $200 on, I'm sorry, you spend $800 on for the course of the month, right? $200 a week. So over the course of the month, you spend $800 on food, and that goes up 3%. That's going to cost you $24 right there. So, and they don't weight it properly in the CPI. They really don't. It's a very messed up sort of indicator. And the problem is the the people at the Fed, the economists, and the economists who look at it, and the journalists who review it, are all people with good jobs. They don't see the flaw in the measurements. Like, they don't look at it that way. They don't say, wait a minute, I use a lot more food than I do gasoline. To you and me, it seems like a wash. It's like, yeah, food went down, gas went up, blah, 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 blah. But meanwhile, there's a lot of people who are making decisions between buying food and buying gas. And when and it doesn't matter if one goes up and one goes down, if the net cost of the two goes up, they have to have less of something because there is no other money. It's really, it shouldn't be hard to relate to this because we all went to college, right? I'm sure pretty much all of us went to college. And that's another, by the way, don't even get me started on college. Yeah. So we all went to college. We were all poor at some point, or relatively poor. I mean, even people with rich parents who went to good schools, you still you don't have all the money you want at some point in your life. You must have experienced some form of wanting money. Most of us lived poor in college. I paid for my own college. That wiped me out. But thank God I did. I borrowed a little bit of money from student loans, but I paid it back by the time I was, I'd say 30. I paid it all back. I was really lucky, but it wasn't a lot of money. I only borrowed maybe $20-something thousand total. And I didn't like having the debt, so I paid it off. But people are coming out of college now $100,000, $200,000 in debt. And could you imagine you starting out in life being $200,000 in debt and having that hanging over your head on top of the insane amount of money it costs to get an apartment and all this rising food costs and everything else? I mean, it's just crazy. That's why people are angry. That's why people are marching in the streets. It's not just about it's not just about the immigrant situation. It's about a lot of things that are pissing people off. And and Trump's going to have himself a $45 million, and that, by the way, is a complete understatement. But let's just pretend that it's let's pretend it only cost $45 million to put 9,000 troops and 50 I know it's 50 helicopters. I don't know how many tanks. I know it's 50 helicopters. I'm like, do you really need 50 helicopters that cost at least $5,000 an hour to fly? Military frickin' helicopters flying in formation. They don't even do that when they're at the Kremlin. They don't even do that. This is a new thing, having a parade of helicopters going along with your parade of tanks. And who are you impressing? It's like, everybody's got missiles, everybody's got helicopters, everybody's got tanks. You're not showing off your hardware. You're not going to intimidate your enemies. I mean, frankly, they'll be lucky if they pull this parade off without a drone strike on his little parade. It's just too easy. I mean, it's just you're just inviting trouble. But then that's what a lot of this is about. It's the same thing as putting all the troops in Los Angeles, it's like you wouldn't have had, you know, you have a problem. You have the police and the people clashing, but that happens all the time. We have protests. New York's got protests all the time. You know, the police de-escalated, and frankly, people aren't as likely to attack the local police as they are the military police, because the military police have a different sort of feel to them. The local police are like, hey, this is a guy who like works. It's just a guy working here, he has a job just like you. But anyway, so by putting thousands of, I think it's 9,000 National Guard people in the streets, you're creating 9,000 points of contact where there could be an incident, as opposed to a couple of thousand local cops who know the neighborhood, know the people, know the streets, blah, blah, blah. You're taking a bunch of strangers, putting them in uniform, and then telling them to defend themselves, stop people from burning flags, blah, blah, blah. Which, I mean, burning flags, we went through this. I mean, we went through this when I was a child. I mean, burning flags is not nice. You shouldn't burn the flag, but if you do, you shouldn't get your head bashed in for it. It's not like a major crime. It's a freaking flag. You know, this has all been through the courts and everything. It's all been decided that that's freedom of expression of some sort. I mean, not to my taste, not to your taste, but you know, people have rights. Well, it did. You know, and as Gavin Newsom points out, and Gavin Newsom, if you listen to Fox News or Newsmax or something like that, Gavin Newsom is some psychopath who's baiting Trump and doing this and that. But meanwhile, in today's post, this is Gavin Newsom's speech yesterday. If you actually listen to it instead of listening to the take on it from Fox, you see a very reasonable guy making very reasonable comments about what's going on and saying, look, we have this under control. This is just a local issue riot. There's no need for the National Guard. This is just insightful. He's the governor of the state. He's taking responsibility for what's going on in the streets. But whatever. Anyway, so CPI. I don't know how we got to that, throwing gasoline on a fire. But so we had this big drop off in April, right? And we didn't pick back up. And now we're coming back a bit, but we're averaging still around 2. Well, we know we were averaging 2. Now we're averaging 210. You know, next month we're going to be back up to 230. And the CPI is going to be up. But the big thing is whether or not the tariffs come into place and how fast the tariffs move through, you know, how fast they get passed through from the retailers to the consumers. And you know, one reason the CPI doesn't reflect a big pass through so far is because the tariffs keep getting delayed and whatever, and because companies are burning off their untariffed inventories. And they haven't hit their tariffed inventories yet, so there's no cost to pass through. Also, the consumers are pushing back. And one of the ways that consumers push back is by swapping. They swap items that they bought, that they used to buy. So in other words, beef got expensive, so they buy chicken. Chicken got expensive, or white meat chicken got expensive, so they buy dark meat chicken. You know, it's substitutions all along the way. You know, they're not buying Charmin, they're buying Northern things. You know, it just, you know, they're not buying Bounty, they're buying the one that rips up and doesn't work. There's 2 things in my house. I always say we always have Charmin, we always have Bounty, because there's a serious difference. I think there's a serious difference. So, and I don't see why. I don't see that as a good place to save money. I think it's like penny wise, pound foolish. But anyway, so last July, look what happened. Last July, energy prices had come down into June, and then we went up from 230 to 260. That's 15% basically. Okay, but then after July 4th, you get to short again. And so that's where we are at the moment. And there doesn't seem to be any great demand for for gasoline right now, and the airlines are not discounting. They're not discounting their airfares because there's robust demand. So there's less demand for travel. And again, this is substitutions. The consumers are not, the discretionary items they're cutting back on because they can't afford them. And oddly enough, sometimes, like if you don't take it, obviously, if you don't take your trip to Florida this year with the wife and the 2 kids, right? So what are you not doing? You're not buying the hotel. You're not buying the airfare for people. So let's say it's $1,000 for the airfare and $1,000 for the hotel is $2,000, and you're saving that money. So now you're home and you have $2,000 more to spend. So you might, as a consumer, be buying other things that you wouldn't have ordinarily bought, and that will show that certain things have a good demand and certain things have less demand. But that's, again, you're not looking at equivalent comparisons, because you're taking a family that was going to spend $2,000 on a vacation, doesn't go on the vacation, instead spends $1,000 on things around the house to make everybody happy and have a nice summer. Like dad goes out and says, well, we couldn't get that, but let's get the let's get the pool, the little pool for the kids. Let's get a trampoline. Let's do this and that. Let's buy some food. Let's get some steaks. Things like that are used for the money. Still, they spend maybe $500,000 less than they would have spent if they had taken the vacation. So that's why it's very tricky in the early stages of economic pullback to identify what's really going on. So there's a lot of moving parts, and you have to watch the total amount of money spent, which we'll get when we have the retail sales report. You'll see the total amounts of money spent on things. And you have to watch the reports from the airlines, so on and so forth. So meanwhile, the bottom line means we're not going to really know what's happening until we get the next quarter's report. And even that is still pre-tariff, because the tariffs don't kick in, if they come back at all. The tariffs don't kick in really until July. Trump pushed back the vast majority of the tariffs until the first week of July. So we won't know until even after that, but depending on what his decision is, that will affect corporate things. And as I said today, in chat we were talking about, it's all bullshit anyway. He only cares about the tariffs because the projected revenues of the tariffs will theoretically offset the tax cuts. So that's how he justifies his tax cuts. Once he gets the tax cuts, once the bill passes and he has the tax cuts, he is no longer going to give a shit about tariffs. He doesn't care about the tariffs, he cares about the tax cuts. Why does he care about the tax cuts? Because he's one of the billionaires that gets the big tax cut. Because he personally made, I think, I don't want to, all right, let's see if there's a number. How much has Trump made since January 20th? Whoops, I hit the wrong number. 230th. No, not since 2023. Oh well, it's like $1 billion, but it's more than $1 billion because he's got that DJT stock, and he's got his coins, and his coins have potentially made him $20 billion. And they're unrealized gains. So the unrealized gains, and keep in mind that this company is now, it's $4.6 billion, and he owns like 75% of it. So he owns like $3 billion of it. It wasn't worth anything before it went public. So now he's got this gain, and he's got his coin gains, which is another massive amount of money on those coins. So obviously for him to be taxed let's say this comes out to $10 billion. If he gets taxed even 10% less, that's $1 billion in his pocket from the tax rule. So, you know, would he bankrupt the entire country just so he could save $1 billion? Maybe. Actually, it's definitely yes, but that's, we'll call it maybe for now. Anyway, so Newsom is probably going to be the next Democratic candidate for president. He sounded very good, actually, when he was doing this thing. So we have this situation here. It's just an excuse to put the troops up. He's testing the law because it's illegal to use the Navy or any branch of the U.S. military cannot be used on American soil. You know, so he's testing that in the courts. So there's a lot of stuff going on here. CPI though, that's right, we're talking about CPI. So you want to look at what the components are of the CPI and what's happening. Look at the VIX coming lower and lower. Energy. So energy, as we said, got cheaper. Bonds are getting a little bit cheaper now. In fact, we just had the auction. I guess it went okay. Earnings report summary. What was that? Beige book comparison. What is this thing? Please give us a detailed breakdown of how the 10-year auction, June 11, just went. La di da di da. .42%, so under 4.5, that's decent. So it wasn't as bad as yesterday. Yesterday, the 3-year auction did not go very well. Oh, wow, it's taking a long time. I guess it was a complicated question. All right, meanwhile, I'll get back to looking. So we have the auctions going on. So what else has been going on? So cocoa is still cheap in April. It went up a lot. Cotton also started rising. Everything started rising in April. So it's kind of a weird month to say, oh, things were good in April because we had this big crash. And what caused the crash? The frickin' tariffs. That's caused everything to crash. And now it's so what doesn't kill us makes us stronger. Lumber collapsed, you know, so things are coming back up. Sugar is still coming down. So you see what's funny is that they're basing the CPI report off of the brief initiation of tariffs, and it forced a lot of prices down. So you can see that really clearly when you look at it this way, is that you can see everything got pushed down at the beginning of April, causing April to come up with a better CPI reading. but that doesn't mean anything. Everything is now rising again, and who knows what's going to happen next month with the tariffs. So it's like a crazy thing to sort of, yeah, it's, basing anything on one report obviously is meaningless, but this whole thing is just silly at this point. So that's what's going on there. We'll get back to who is looking it up. Not the Fed, not the beige book. What the frick? Oh, here we go. Decent but shy of stellar, clearing a slightly higher yield than traders wanted and showing demand just under the recent norms. Here's a play-by-play and what it means for the curve. Oh, good job, though. Good. It's a good job. Auction snapshot, $39 billion. We see this is just the 10-year selling $39 billion. Same as April, smaller than May, 4.25%. 4.242 is a little high in the high end. Price blah blah blah. Bid to cover 2.52 is a little bit less bidding than usual. Indirect takedown is dropping. Direct takedown is high, and the dealer allotment was 8.9%, and that was low. So that's all right. So the dealers had little unwanted paper. So everything sold. Things that needed to sell. So it was a decent auction. He's giving it a B minus. See, interesting, right? But what's the gist of it though? Is here's March, 4.3, 4.35, 4.34, 4.4. So the bottom line is we're up a lot since 3.1, right? Then 4.3, that was a big jump. Wonder what that -1 is. Anyway, so this went to 3.1, then it went to 4.3, then it went back to 3.4, and now it's back to 4.2. So it's sort of wiggling around in that area. Today's sale is the first positive one since March. Evidence April's tariff-driven sell-off has not fully rebuilt the buyer cushion. The bright spot is foreign bid. Indirects are constantly absorbing. 68.71, suggesting global reserve managers still prefer the belly of the curve. So 10-year cash is 4.46. S&P futures pull back a tiny bit, but nothing special. And wide demand this week delivers $119 billion across the supply. Investors keep powder dry for Thursday's long bond. That's a 30-year tomorrow. Fed funds futures have trimmed September easing odds to 55%. Hotter PPI, raising concern. Dealers report that a 5-point Trump tariff risk concession is embedded into it, so they're still worried about the tariffs. Front end carry, bottom line. So it's healthy but not great. That's the bottom line. All right, good. Got that out of the way. And so this is where we are now. So what did we do? We see if we have an hourly. How far back's the hourly go? Yeah. Unfortunate. Oh wait, I bet I can do this. All right, so keep in mind we're at 6050. On May 15th, we were at 5950 and we decided to cash out because we were worried about what was going to go on when the tariffs hit again. We're still worried, obviously. It didn't change. Ooh, well, that's nice. Okay. So on May 15th, here, after, don't forget, we were way down here. So on May 15th, we were like, well, thank God. And we got the hell out of our portfolios and went back to cash. On May 22nd, as we started coming back down a bit, we did a review, and let's take a look at that. May 22nd is earlier. May 20th, oops. So there. So don't forget, we cashed out on May 15th. And May 22nd, we took another look at what we cashed out at. All right, so here we are. I think that's the first one. Yeah, okay. So we took a look back at the stocks that we cashed out of, and we're going to reincorporate these into our watch list. Where's the watch list? La-di-da. Watch list, watch list. Okay, so here's the updated watch list. We talked about that last week. All right, so not all the stocks that we had in our portfolios are on the watch list. And the nice thing about putting it on the watch list is we have these dynamic charts, and we're going to update our assessment of each stock so you can see where they are. And then we can just scroll through them and see who seems like a good deal this week and decide who we're going to pick up. Like, here you go. Here's Baxter. Why don't we get into Baxter? And if we have a good reason, well, in fact, our last assessment was here, ready to accumulate. So they came down a bit, they're cheap, and they're ready to accumulate. So good one. Best Buy we were just talking about. I think they're a little bit better than they look. BXMT is a good one. Anyway, so you go through. So we're going to add back these stocks. And you know, and a lot of them were pulled. You know, they went from the watch list to stocks that we had, so they went off the watch list. We didn't keep them on the watch list, most of them. So anyway, we got stocks to add back. We have Apple, and here we said, and at this time we were saying, should we put it back on the watch list? And we said yes for Apple. AstraZeneca, high priority, means that we actually would like to buy them back. BHP, yes. BP, move on for now. Caterpillar, yes. Cisco, yes. Cisco I love, so that's one I definitely want to add back. CVS, cautious. Delta, yes. They're almost all going to be yes because they're going to be yes because they just came off our portfolios in May, and then the market got cheaper, so they were all better priced than when we got out of them. Disney, Dow, cautiously, and that's only because the price is still high. ENS, no, not yet. IBM, absolutely, and IBM's making all-time highs now. I wish we had grabbed it back then. International Paper, Johnson & Johnson. See, they, you know, when you look at our portfolios, right? They're full of blue chip stocks. We don't mess around. We're not like chasing after bullshit in our portfolios. And that's why when you look at this list now and you're going, wow, that's a good company. Oh, that's a good company. Oh, that's a good company. Because that's what we buy. We're value investors. We buy good companies. We don't buy speculative bullshit. You know, we'll play around with them sometimes. But you know what? In the early stages, when we're building our portfolios, then we don't buy bullshit companies. We don't chase after things because we want to make some slow, steady money. It's very tedious. The first year that we have portfolios is very slow and tedious because we're just looking to build and make some profit. Once we make some profit, I don't mind being a little more aggressive with the profits. But I don't like to be aggressive with our principal. I like to use our principal to make sure we make money and get ahead. So we don't mess around when we're building our new portfolios. We look for good blue chip stocks that are trading at good prices. Coca-Cola, high priority. Levi's, Mattel, Newmont Mining, high priority, of course. Pepsi, Pfizer. For me, that's a high priority. I love Pfizer. TD Bank, one of the best banks value-wise. TLT, I want to know how TLT end up. It's interesting. Well, that's not TLT. Well, up a bit. Yeah. So don't forget, this was May 20-something. What's this date? Where's the date? Oh, there it is. Yeah. Oh, that's when we talked about TLT. That's funny. Okay, so there you go. That's called picking a bottom. And we liked it because it was a hedge also. Valet, we still like them. Verizon. I mean, that's about as speculative as we get, is picking a stock like Valet. Whirlpool, we just picked that back up for the long-term portfolio. It's too cheap to ignore. Exxon, I'm not sure the demand is justifying Exxon at the moment. So that was just our butterfly portfolio. From our income portfolio, AGNCU pays a nice premium. Blackstone pays a nice premium. Chimera pays a nice premium. Energy Transfer pays a nice premium because it's our income portfolio. These are income producing stocks. New Tech, Annaly, another one that pays a nice premium, another REIT. Euronav, I'm not sure if I want to get back into them. They were a little disappointing. Crocs has been great, and Skechers went private, so money has to move to Crocs for that. Foot Locker, I thought, was very undervalued. General Mills, Intel. How's Intel doing? Oh, Intel's still way down there. Look at that. It is, but you know what it is though? I love Intel and I like it for the long term, but it's too risky for our brand new portfolios. We're not ready for that kind of risk yet. I'd like to have Cisco, but they're a little bit expensive too at the moment. Jack in the Box is too risky for to put on our watch. It's not too risky for the watch list. It's too risky for to put in the portfolios right now because it's a little bit speculative. I very much believe in them, but it's also very possible that they go lower, or they take a long time to turn around, or they don't turn around at all. Yep, they're still in the same place. You know, watch list doesn't mean buy list, it means watch list, because Coca-Cola again, Macy's, and again, I love Macy's, but it is highly speculative. Therefore, we don't put it in our brand new portfolios because they haven't made any money yet. I'm not ready to take a risk. Bank of Ozark is another one that's could go lower. Pfizer is one though that I can always make money on. Pfizer. SoFi, if they just shot up, unfortunately, I love them. AT&T is another one. Yes, you get, well, if you play it for the dividend, you get a nice dividend and generally very steady stock, great to play. At the time, UNG, but it got more expensive now. United Parcel. I like what United Parcel has done. United Parcel is reducing half of their business with Amazon. They told Amazon, go find somebody else to deliver half of your packages. And the reason they did that is because Amazon had cleverly negotiated such a good deal that UPS doesn't want them anymore. That the deal doesn't work for UPS. And that's an important thing in business you have to realize. Your supplier's got to make money. Because if your supplier's not making money, he's either going to cut his staff, he's going to cut corners on the quality of the product that he's selling you, he's going to de-emphasize your work. You know, he'll fulfill his contract, but he'll look for people who pay him better money before he services you. So if he's got a new customer that's 1/10 of your size but pays him a profit, he's going to care more about that guy than he cares about you. Why? Because you screwed him. This is a lot of big businesses make this mistake. They push their suppliers into such a corner that they can't make money anymore, and it deteriorates the relationship. And that's what happened to UPS. So UPS is saying, I'm sorry, Mr. Amazon, but you're going to have to find somebody else. And I think it's great. I think it's fantastic for UPS. They have plenty more business to get. Deliveries are rising, not falling. And Amazon is just sucking up their bandwidth. So people are starting to pick up on that, but I was all gung-ho for it. So it's 96 and now it's like 1, whatever the heck it is. But it's gonna go, they'll go back to normal. There's nothing wrong with UPS, and look at where they're trading like 13 times earnings. Fire your customer. When I was a consultant for businesses, I used to say that all the time. I'd say to people, you have to look at the 10% of your customers who are poor performers, and you have to do your best to replace them. You have to get rid of the people who aren't making your business any money. And that's something that a lot of businesses neglect, because you talk about growth, right? And you're trying to grow your business and you're trying to get more customers, but you have an acquisition cost to those customers, and then you have a service cost to those customers when they come in. But meanwhile, you've got a bunch of customers, and I'm talking about the bottom 10% of return on your investment customers who could be costing you more money because you're barely breaking even. It's an old customer, it's your first customer, it's an early customer, it's your biggest customer who negotiated something. But you got to run the numbers and say, is it worth doing? And I know it's mean, because early on you could have one great big customer who makes your business. Like you know how it is. You land that one big customer and they're like making your business. They lay the groundwork for all of your future success, and they know it. And you know that and you probably told them that you owe everything to them, blah, 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 blah. But meanwhile, for whatever reason, you're still charging them a price that's backdated 5 years or something like that. And they give you shit about raising prices, and they ask for favors all the time and this and that. You got to step back and you got to analyze your business and say, can I afford this person? Because this customer who's 5% of my total company or 10% of my total company's business is only making me 1% of my company's money. And if I got rid of them, instead of spending tons of money to expand and hire new people and so on and so forth, I could just replace him with 10% more business that has a 10% margin instead of a 1% margin. And all of a sudden, I'm massively profitable. And I'm not saying just completely fire somebody, whatever, but you do have to think in terms of like, okay, I got to give this guy an ultimatum. Either I got to say, look, I'm either passing this cost on to you. You're either going to start paying me like a premium service, or I'm going to have to unfortunately say to you, I can't do your business anymore. And they'll be pissed, and it's going to be painful, and so on and so forth. But if you don't learn how to do it, it's very hard to grow a business successfully. There's Valet again. Notice the same stocks come up a lot because they're the best stocks. So what am I going to buy? The worst stocks? It doesn't work like that. We try to buy the best stocks. So there's Apple again in the long-term portfolio, Akamai, AMD, Barrick. How many of these stocks do you see here that aren't like obvious purchases? Cleveland Cliffs, this is speculative for us. I do like them though. Coinbase, we had huge success with, and we got out because and they're a little expensive now. Crocs again, CRISPR is another speculative. Cisco again, Dollar General. DHI I like, Ford I like down here. It's tricky though with the tariffs, so it's not one we jump on really. Geo Group is building prisons for Trump. Corning, GLW. I mean, Well, I'm not sure what this Apple Glass means for Corning. That's one thing we got to look at to see whether or not that's still a thing. But I do like them a lot. Generac I love, and especially as we have the next season of national disasters with who knows if FEMA is going to come to the rescue is going to be very interesting. IMAX, a lot of blockbusters coming out. See, IMAX is always a good one when they're down if you pay attention to the releases, and there's a good, strong release season this year. And at the moment, they are not cheap. No, at the moment, they're at the top of the range. See, when they're at the bottom of the range, I love to jump in on IMAX, because what happens is there's a few bad movies. It's not IMAX's fault that people make bad movies. but people sell them off as if it's like as if IMAX is a fad. It's not IMAX is a fad. It's if you thought your movie was going to do really good and it does crappy, like the last Captain America movie, right? So IMAX has already booked a month for Captain America. Like they've already planned a month run for Captain America. It's not like a normal movie theater. See, in a normal movie theater, they quickly drop the number of screens and put other movies on and so on and so forth if something doesn't work out. But IMAX can't really do that because the IMAX, you guys have probably seen it. I mean, they're more digital now, but IMAX used to have these huge reels, but the whole production thing and all that for IMAX, you can't just take any old movie and put it on IMAX. It would look like crap. It has to be an IMAX movie to go on that screen. And therefore, they're very carefully planned. It's not so, and if a movie does poorly, it hurts IMAX a lot more than it would in a theater where they just substitute something else. IMAX is stuck showing Captain America for 4 weeks. That was their run for Captain America. It was supposed to be a $400 million movie, and it turns out to be a $150 million movie. That kills IMAX. They suffer from Disney's stumble. So that's, you have to realize certain stocks are affected in weird ways, and that's great chance to jump in because they didn't do anything wrong. But you always have to look ahead and see what the upcoming movie schedule is, and then you have to think of like, is that going to work? Are these movies likely to perform, or are there potentials for problems? Invesco, I love. Jack in the Box again. JP Morgan, obviously, it's like a money machine. Kraft Heinz, CarMax, I wouldn't put back on. Too scary. Lockheed Martin is Lockheed Martin just got slammed today. I did the numbers on this too. LMT. I wasn't done, so I didn't bother talking about it. Wow, look at that. So actually, they're back to where they were in May. So it's actually a good chance to get back in. So Lockheed Martin, the Air Force is ordering less jets. So the headline, let's see if we can find that. Yeah. Lockheed Martin plunges on F-35 orders. It might be an overreaction. That's true. Here you go. Lockheed Martin stock plunges. So, you see how it kind of progresses over the course of the day. The initial reaction is to these headlines. Lockheed Martin falls after Pentagon slashes F-35 request. Lockheed Martin worry on F-35 orders. Lockheed Martin plunges on worry over F-35 orders. So let's see if we can get some facts. The Air Force last week asked for 24, down from 48 last year. So half as many of the planes. 3.5 billion. So obviously if 24 is 3.5 billion, which is insane if you think about it, but 24 planes is $3.5 billion. Last year, then they spent 3.5 billion more than this year. So now you can't just take that and say, oh my God, Lockheed Martin is screwed. You have to look at Lockheed Martin and say, oh, well, several things you want to look at. It's 3.5 billion out of $70 billion in revenues that they are canceling, right? But then the question is, how many, it's like Boeing, it's like how many F-35s can they deliver in a year? And then I don't know if it's going to show up on this thing. So the Air Force is ordering 34 less F-35s, but if we say LMT Canada, Canada boosts defense spending by $30 billion, and guess what they're spending it on? They're basically spending it on Lockheed Martin. Oh, here you go. Canada's F-35 purchase is now at $30 billion. It's Canada's procurement of 88 F-35 jets. And that was not their business last year. So, so they lost a few from the Air Force, and they gained a bunch from Canada. And not only that, though, but so how many F-35s did LMT deliver last year? Not in Canada. Lockheed Martin delivered 110 F-35s. So in other words, they don't have the bandwidth to deliver all the F-35s that are being ordered anyway. It's just like Boeing. It's like if one company cuts out, like even, well, they don't really do that because nobody wants to get out of line. So in other words, there's a huge line. Boeing has a 7-year backlog. Nobody cancels an order with Boeing. It doesn't change anything. All you're doing is it's like if you have a reservation, you say, take my name off the list. It's not like it costs you anything to have your name down there. So people will leave themselves on the list until the last second, until the time that they can't get out anymore. There's a certain time where you have to make a deposit. But if you're just on a waiting list to own some Boeing planes, you don't get out. If you're 3 years away from getting your delivery, you don't say, oh, I'm canceling that order. Why? Because if you want to go back, you're going to wait 7 years. All you do is screw yourself. So, and of course, Trump obviously makes decisions not based on that kind of rationale. So to save money, to show his better budget, he wants to knock off something, so he cancels half the F-35 orders. But all that does for the U.S. is sort of put them, well, they still got the 35 that wherever they're getting delivered in line, but then other countries like Canada jump in and say, oh, great, we're going to take 88. And they say, and then somebody else is in line behind them, and somebody's behind them, and somebody's behind them. And if the U.S. wants to order again, they're going to just get in the back of the line. So all this does is push up other people in the line to accept the same planes this year. It's not going to affect Lockheed Martin's net profits or revenues this year at all. It's going to, down the line, if they don't replace the orders, it'll affect them, but it's certainly not affecting them now. So that was an overreaction, and people already realized that this morning, because look what happened. It went down like that, and then rational people looked at it and said, this is not a big deal. So yeah, great opportunity to buy Lockheed Martin, great time to sell a put, because of the volatility of not the entire market, but of Lockheed Martin stock has shot up. So therefore, LMT so where are they? 455. So the 450 puts are $47. And if we go to charts, flexible grid, make sure I got the right one. Of course I do. The 450 puts. So the 2027 450 puts just went off at somebody sold a contract for $51, and they were 40 yesterday. So you're getting 20% more money for selling that put at 450. So that's a great way to start a trade on Lockheed Martin, because now you can do that. And if you get assigned, if you sell that put for $50, the 450 put for $50, if you get assigned, you're getting into Lockheed Martin for $400. Okay, and when's the last time Lockheed Martin was $400? Briefly, So way back here in 2022, okay? And let's see before that. I don't know if you imagine that's probably where it was. Yeah. Yeah, so basically in 2022, it was 400 bucks. It hit 400 in 2020. So now, let's take a look back here. Oh, this is Lockheed Martin. So in 2020, they had $65 billion in revenues and made 10%, made 6.8 billion. In 2022, they had 65 billion and made 5.7, so less than 10%. And in 2025, it's 70 billion and they're making 6.3 billion, so also less than 10%. Next year, 77 and still less than 10%. So numbers wise, they're making as much 2025, 2026 as they made back in 2020, 2021. And as you can see, they've just sort of been getting steadily rising in price. But this money where they are now at 450, if you net in for 400, you're certainly netting in at the right price, at the price that consistently has held up for all these years at a profit level that's held up for all these years. It's not a great price. It's 16.7 times earnings. So it's not fantastic, but it's a good price, and you're not going to get much better because Lockheed Martin just keeps going up and up in general. So we have a nice chance to take advantage and get back into Lockheed Martin, and we will take advantage of that. Medtronic is medical devices. We like them. MP Materials, they just got, I think I said this already, didn't we? MP Materials got screwed today because the China deal puts more rare earths back on the market, but that doesn't mean that we're not going to be still investing in MP Materials. So it's kind of silly. But you know, people react to news headlines for not particularly good reasons. So you're down 8%. But they've already had a nice run. So we'd actually like them to be down a bit more before we jump back in here. They're very, I mean, look at the forward PE. They're very, very speculative. But now that's interesting. So usually I would never like a stock like that. But here's the thing. The valuation is only $4.5 billion, okay? So at the moment, they have 0 sales, so 250 times earnings. Even here, it's 100 times earnings. So they make 6, well, it's not 100, it's whatever. What did I say, 4.5 billion? So 4,500 divided by 7. Let's give them 7. Oh, what? It doesn't make any sense. Oh yeah, I guess it does. All right. It's worse than I thought. So yeah, so 600 times earnings. And what are these guys saying? Well, they say nothing. But in 2021 and 2022, before they started expanding and spending a lot of money, and before their sales went down, and you see how they're coming back up there. So they're into an expansion thing now, and they're spending a lot of money, and that's crimping their profit. But the cash flow from 462 is more like a couple of $100 million. And especially if China screws around with the rare earths and increase their prices, it's going to be great for MP Materials. So if you take, well, obviously, if you take 4,500 divided by, whoops, what is the number? 289. Well, let's average those out. 135 and 289 is 3.4. So let's call it 2. If you divide it by 200, let's say they make $200 million, then you're at 22.5. So that suddenly is a reasonable price. And they do not need spectacular growth to get there, and they are going to get there. This is an expanding rare earth supplier in the United States that many people are going to be investing in, and Trump is deregulating and saying, sure, you can strip mine, and that also lowers their costs, because these costs came about under much stricter environmental regulations. Now they don't have to worry about like killing fish or things like that, and they can go right ahead and just strip mine and do whatever they have to do to get the rare earth. So a lot of things in their favor, and people are looking at it like it's a 200, 300 times earning stock, but it's not. It's just the phase that they're in right now makes them look that way, as many miners do. So they're an interesting play, but again, a bit speculative for our brand new portfolio that hasn't made any money. What's to their advantage though is that they're only $20 stocks, so we can certainly afford to take a small chance on them. Merck, of course, money machine. Moderna, too dangerous right now because frickin' Kennedy is running around trying the fact that they want to vaccinate people makes them the enemy. On semiconductor, I like, but too speculative. Paramount is over. They're in the middle of their merger thing. Also, they're being sued by Trump, which makes them dangerous and very scary, because if they capitulate to Trump, which they very much might because they want to get their deal done, but if they capitulate to Trump, it sets a terrible, terrible precedent for the rest of the media. I watch Stephen Colbert very closely. He's very, he's pretty anti-Trump in his monologues, and I watch it very closely to see if there's any kind of pressure coming down on him. I don't see it so far, nor do I see it on 60 Minutes, even though they're the ones that the lawsuit is over. And Trump's lawsuit, Trump's $20 billion lawsuit, because that's what he says his damages are. So that's idiotic anyway. But Trump is suing Paramount for $20 billion because they edited the interview with Kamala, whatever the hell, Kamala. See, we all forgot about it already. They edited the interview with Kamala Harris to make her look good, which damaged him and caused him grievous harm because she looked good. Not that he was on 60 Minutes and they made him look bad. Somebody else, his opponent, was on 60 Minutes, and in the editing, they made her look better than she was. Therefore, it hurt him. That's the lawsuit, but it doesn't matter, because it doesn't matter how stupid the lawsuit is. The lawsuit costs money. It ties them up in court. They have to say to their investors, we have this $20 billion lawsuit against us. The fact that he picks this outrageous figure and pushes it in the courts means they have to count it as a potential liability, which stops him from doing things. Also, he's having his FCC, which is completely illegal, hold up their merger with Skydance. That Skydance has made an offer to buy them. So they should get bought out and everything should be done. And Trump's holding the whole thing up, which of course is very damaging to the company. Now they can turn around and sue him for that. But, this is insane. So we'll see. Meanwhile, so obviously not something we want to jump back in on. Pfizer, I think that's in every portfolio. Is Money Machine, Prudential, I like them. Although you never know with the insurance times, so you have to be careful about that. Qualcomm, love Broadcom too. I don't know if they were in there. RH, I always like RH when they're low. I don't think they're very low right now, but let's see. La-da-da. Ooh, nice. Yeah, RH is very cheap. Look at that 4P, 13. Now, you might say, oh, RH, that's expensive hardware, blah, 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 but it's expensive hardware. Unless you're in the top 10%, I would pretty much say that you don't know anybody who shops RH. So, it's people who have a lot of disposable income shop at RH, and they're not going to go to Home Depot for their next set of faucets just because the economy's bad. It's not, I'm pretty sure almost every married guy in the top 10% knows that this is not a decision you get to make. Decorating decisions are not based on whether or not you can, on how easily you can afford something. It's going to be right, or it's not going to get done, or you'll just have these stares every time something squeaks, or every time something, every time your wife goes to, like, use the faucet, she'll look at you and be like, oh, you failed me. It is not a place. And RH is also, they spend a huge amount of money repositioning themselves as a total lifestyle brand, like Hammock of Schlammiker. Remember that really expensive catalog used to be around? So they're kind of like that. They're kind of like except it's an actual store. They're a store full of like all the best stuff and blah blah blah. And they got their audience, and people go in there and they spend ungodly amounts of money. Ultra rich people just go in there all the time and go, I'll take that, I'll take that, I'll take that, I'll take that. And and the rest of us are just looking mostly. But if you see a really nice shower head and it's $150 at RH, and it's $49 at Home Depot, but it's it's a normal water pick thing, then you end up buying the thing at RH. It's like you go, $150, I'm just buying it once, it'll last forever, blah de blah. So I like them. This is very cheap for this company. They'll be around forever, and they're also great to sell puts and calls against. So we are very, very happy to own these guys. SoFi, love SoFi. They're up at past 14 again, but I absolutely love them long term. They're also great to sell puts and calls against. That's always a factor for us. Steel Dynamics, too speculative with the tariffs. Tech Resources, too speculative. Target, I think, is beaten down for bad reasons. I'm not sure where they're at now. But I have this thing with the retailers. It's like, they don't really get affected 98. So they were 95, so they're actually up. The thing about Target is they know how to make money. They've been around a long time. They understand, like prices go up, prices go down. Different countries have different problems at different times, and so on and so forth. They know how to deal with all that. They've got, and this is where AI and any kind of computing is very helpful, because it's like, basically they're like, we need to fill these shelves. These are the items we have. I could easily, if I filled a Warren up with an inventory list, and let's say I would say to him, I'd say, okay, we have these 20 soaps of what we carry usually, and these were the prices last year, and these are the margins, and these are the prices this year, and these are the margins. So which 3 should we drop? And he's going to look at all the numbers and look at all the things, say these are the ones. Same thing. It's like dropping your customers, like drop your least profitable items. So he's going to say, okay, based on the new situation, the new tariffs, blah 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 blah, these 3 should be taken out. And then you say what? And then say, well, here's all the things we've been offered. What are the best things to swap in? And he'll say, swap this for that, swap that for that, and swap that for that. And boom, you're done. It's not hard. It's unbelievably easy these days to get all your metrics and get your numbers and be able to do that and be efficient. So people aren't taking that into account, and all they have to do is change their product mix. And it'll be based on what the consumers do like, what sells in the store, what the price points are. All these are known quantities. And people aren't, the people shopping at RH might be really picky about what they're buying, and they'll only buy a certain thing, and it's got to have this and it's got to have that, blah 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 blah. But they're not price sensitive. The people at Target are price sensitive, and if you don't have Ivory soap anymore, but you have this Dove bar that's basically the same thing and cheaper because they're sourcing from better places, then boom, people are going to switch, especially if you have a coupon. There's also ways to incentivize people to do this stuff. So anyway, so same reason I like Best Buy, I like Target, and more so Target. United Health, oh my God. Could be a great opportunity, could be a disaster. It's hard to tell. They just got the new CEOs. New CEOs like to what we call kitchen sink the quarter. And the new CEO is an old CEO. But either way, when a new CEO comes in, they throw everything bad into one quarter, and blame it on their predecessor, so that they look like they did a phenomenal job of turning everything around, more so. Meanwhile, though, the only thing that really is driving this is the very slim possibility that they may lose their designation as a Medicare provider, that the U.S. government will no longer reimburse them, and that's a big deal. But it's probably not going to happen. It's a relatively minor thing where they have coded something one way and the government doesn't agree with their coding, and they may pay a fine, they may do a rebate or something like that, but it's very unlikely to sink the ship. But it could, so everybody's freaking out, because it's a binary situation for them, because if they do have major troubles and the government does threaten them, that's their whole business. It is possible their whole business can be taken away. And of course, you also have the argument that nobody's really thought about that as a business that could be taken away before. So now that's going to be a complete overhang on them forever, is that the people look at them and say, well, you're completely reliant on the US government as your customer, and the US government could be run by a maniac who you never know what he's going to do next, and you could lose all your business in 2 days' notice. And nobody's ever thought that way before about their business. So that puts a big risk premium on the business that didn't exist before. But demographics wise and everything else, it's like, this is a home run company. The growth, the aging population, the rising healthcare costs, it's all in their favor. So this is crazy. This is even so an overreaction. 400, I would say if you cap them at 400, sure, but for 300 is just way too low. So yeah, I kind of like UNH. It's just I wouldn't want to commit too much to it, but I want something. Here's UPS again. Here's Valet again. Western Bank is a good one. Whirlpool again, we love them. XYZ, XYZ was Block, and Block, I like them, but it might be a little speculative. There's a lot of competition heating up in that area. Good old Yeti Holdings, I love them, but they got expensive, I think. Yeah, they went up a bunch, but not too terrible. And again, see the 15, 12. They're not unreasonable, and if we set them up as a selling vehicle, they're going to be kind of fun to play with. So I think I might like those guys to put back in the portfolio. So anyway, so there's that, and we put all those things back into the watch list, and then we start looking every week. We look for a couple and say, what could we add? What's relatively cheap at the moment? And that's why we have these nice things. So you see how it works. We have like Chimera, it was 1860 when we first watched it. It's 1335 as of June 4th. And today it is 1405. So that was a good time to buy. It was when we did this, as of June 4th, obviously. When did we do that? June 4th, it says so. Recommendations still watching. I love them because they pay a gigantic dividend. It's not, you don't own it for the growth, you own it for the huge dividend that they pay out. And that's a good point. Let's do that because it's we don't have that long. So if I'm going to buy Chimera, so CIM, they're a very, very well run real estate trust. And sometimes that happens, and when it does, it's a good time to stack up. They had just paid their dividend, and people were bailing, and their earnings weren't spectacular, and this earnings wasn't good either. But look at the PE on these guys. They're trading at 8 times earnings basically. They're paying a 10% dividend. I mean, that's crazy, right? So they're paying it. They're paying these dividends. They have to pay out 90% of their earnings in dividends. That's a rule with the REITs. So they return all their profits to the shareholders. If you look at them for years at a time, they all very, very good. In 2020, they went way down in value. They regained some, they went down, but now they're at a point where they're just stupidly cheap. And so it makes it a really fun thing to play. And especially because what's the price? $14. So they're $14. And if I go to CIM, so let's say we buy 1,000 shares of the stock for 14,000 bucks. And here's December. The stock's at 14. I can sell not even the 14, but the $13 calls for $1.50, right? So if I'm selling, if I buy the stock for 14, what's going on here? If I buy the stock for 14 minus $1.50, selling the $13 calls, and then I also sell the $14 puts for $1.40. So now I'm in the stock for $11.11. If they're above 13, because I sold the 13 calls, I'll get called away for $13, but that's $1.90 profit. So 1.9 divided by 11.1 is 17% in, where'd it go? Is 17% in how many days? 200 days. Not only that though, but if I collect my dividend, which is, now I've lost that. So the dividend's like 30 something cent, like let's say it's 35 cents. So the dividend's like 35 cents. If I collect my 35-cent dividend and I can see when they paid their dividend. So this was last year. So they've only paid one. So I would get 3 more dividends. So that's $1 in dividends on top of. So now I'm collecting in 200 days, I'm going to collect 25%. So if they're over 13, we get called away on the longs. If they're under 14, we're going to get assigned more. But since our basis on the first 1,000 is 11.11, look, what do I keep hitting? And then plus 14, if we get 1,000 more, then we divide that by 2, is 12.55. So the stock is currently $13.93, not including the dividends. If I end up with 2,000, so if I buy 1,000 shares now, I drop my basis to 11.11. So it cost me $11,100 to do this trade. If I get called away, I'm going to make 25% in not even a year, not even a year, barely 6 months. So if I do it, I'll make 25% by December. Over 14, I'll get called away. If it's under 14, I'm going to get assigned more, and my average on 2,000 shares will be 12.55. 12.55 is $1.50. It's about 10% below the current price. But that's in 6 months. If I can drop my basis plus I get the dividend, so it would really be back to 11.55. If I collect my dollar dividend, I'm back to 11.55, right? So now I've got an 11.55 basis, and I've dropped $2 plus off the price in 6 months, 7 months actually, so 7 months. And if I do that again the next 7 months, and again the next 7 months, how many $2 drops will it be before I have free stock? And a shitload of free stock, because I'm dropping the basis on the whole batch every time. And I'm collecting more and more and more dividends all the time. So you don't let the decay of the stock bother you, because look at this. This is going from 18 to 14. So 18, 16, 14. That's fine with me. We would be even and collecting all of our dividends. And eventually we'll have free stock. And it doesn't always go down. When the conditions change, when the interest rate conditions change and the housing conditions change, they can make a huge amount of money. So that's why we love to play with those. They're really fun, and they can really enhance your portfolio, because you just end up owning a huge amount of stock that you paid net nothing for. And by the way, the erratic nature of this is because also they don't always, they divest. So in other words, sometimes they'll divest their stocks and they'll sell and get back to cash, so they have buying power for the next cycle. So in other words, at this point, they held a larger amount of buildings and they were collecting, that kind of money. Then they sold off or did something, and you'll probably see it in their cash. Well, you see it in their dropping debt. You see how they went from 21 billion in debt to 10 billion in debt, and they're still at 10 billion in debt. So sometime around, what year is this? 2020. So around 2020, they divested quite a lot of properties, or they cashed in a lot of properties that were in their portfolios, or mortgages that were in their portfolios, whatever it was. And that caused, see 2020, that's them paying off $10 billion worth of debt. And how do they do it? They reduce their income base, their portfolio of mortgages in this case. They reduced it by cashing them in, so they had more buying power for when they were ready to start going back at it. And so meanwhile, that has drastically reduced their incoming revenue. It hasn't, 2021, notice it went down. It was 414, 88, 670, and that's probably recognizing the gains from the mortgages they had. Then they probably reinvested or did something here. And meanwhile, so they've dropped considerably in their collections and in their profits, but still it's 144. They only have a $1 billion value now. And they're making 144. That's crazy. You don't compare them to what they were, because they're not that kind of company. They're not making toys. They don't have factories. What they do is they buy mortgage-backed securities, and they hold them, and they collect interest, and they collect rents on them, basically, or interest on them, on loan portfolios. And every once in a while, they will reduce or increase their supply in the portfolio. And at the moment, they don't see it to their advantage to increase their portfolio, so they're holding pat and making good money based on what they thought. You have to figure out the whole story of a company. You can't just go by like this and that. And that's why people who use stock screeners, they miss a lot of good stuff. All right, so Swamp Fox says, Phil, while we're looking for these blue chips, you've recommended some recent stocks, pins. Oh yeah, we did Pinterest for the LTP that aren't blue chips. Are these positions that will go into the LTP? We did put Pinterest in the LTP. I don't consider Pinterest, I'm not going to get into it now, but I don't consider Pinterest to be it's not a blue chip stock technically, but I consider them to be a very well established social media platform, and value wise compared to Reddit, which has been getting a huge amount of attention. I will show you that. Pinterest has 10 times, here's Reddit. And Reddit had recently had a very good day. What was that? I don't know. Sometime in the last couple of weeks, Reddit had a really good day. I think it was like here where they went from 112 to 120 or something like that. And I was like, why are they going up so much? And I looked at them and I'm like, I wouldn't buy this. It's 70 times earnings, 21 billion in market cap, and they can't even, they're not even making 500 million. They're projecting it. They're projecting great growth and so on and so forth. And they're 2 billion and they're dropping 10% to the bottom line. Maybe they're going to drop 20% to the bottom line, they claim. I don't see that's realistic execution. But then I look at Pinterest and I'm like, isn't Pinterest like way bigger than them? What the hell? Uh-oh, it's broken. So now look at Pinterest, same market cap as Reddit, double the sales, and already making $1 billion. So their PE is 18 versus 70. And they're not claiming they're going to double next year, but I don't see any reason why they can't keep going the way they're going, and not to mention they've been investing a lot of money in AI and stuff. So they're possibly going to explode. They just don't have these ridiculous claims of growth. Don't forget that the Reddit is saying they're going to make that Reddit is making 200 million this year. They say they're going to go to 500 million next year. Meanwhile, these guys are double, they're double what Reddit projects. And they've already got the eyeballs. They've already acquired these customers. They don't need some huge leap of faith to believe that they're going to get there, that they've got some crazy plan to do this and that and blah, blah, blah. And also, Reddit is essentially a chat board, while Pinterest has like an actual, a moat. They've got an actual business with a moat that's hard to duplicate. So yeah, it's not an S&P 500 company yet or whatever, but it's a very stable company in their sector. It's a best of breed in the sector, and everything doesn't have to be by definition blue chip. It's just a type of stocks we look for, are Warren Buffett type of stocks that have a defensible moat, that have good management, that have solid growth, that look at this every year. 16, 25, 28, 30, 36, 36, no, that's not a year, 36, 41, 48. That's good, steady growth, and the profits are growing along with it. That's the kind of company you want to invest in. And again, labels hurt. Having a narrow mindset because I said blue chip and saying, that's not a blue chip, you can't do it. It's like, yeah, I can. I see the value in the stock. It's that kind of company. And that would also put out the REITs also. They're not technically blue chips, are they? So we don't go by that. We go by whether or not we think it's a good, solid company that doesn't have a lot of risk and is worth putting money into. And Swamp Facts is asking if we are going to post it to the postings to the LTP. Yeah, that's what we do next week, like we always do. On options expiration week, we do a portfolio review. That's when we do our portfolio reviews. That's not changing. So we have some new stocks that we've already added to the portfolio review. Pinterest was, I think, the first thing we added, and a few more that I mentioned along the way. And that's where we are. So lots and lots of fun. And let's see if there's anything exciting going on in the news. But we have, as you can see, we've got a couple of hundred stocks to choose from, and there are plenty of them that are in a position that make them attractive to us already. So we're not missing anything by being in cash and just watching what happens until Trump makes his actual freaking decision on what happens in July. Most likely, what he's going to do in July is pump the football again. And like I said, unless he gets his bill. If they pass his bill, which he set the deadline for the bill is July 4th. The deadline for the tariffs is July 9th. There's a reason for that, because he wants to pass his bill. He doesn't give a crap about the tariffs as long as the bill passes. If the bill does not pass, then he's going to kick the tariffs back again and tell people to get the bill done. And there's a reason for that too. He needs to pass the bill without passing the tariffs, because the tariffs are a nightmare and they're not going to work. And as soon as people understand that they're not going to work and that he can't enforce them, then his entire tax bill calculations have to change, and then the tax bill doesn't work. So he only can pass the tax bill while he's pretending the tariffs are going to work. Not only that though, but the Doge thing is falling apart. That's another problem he's got, is that the auditors who are looking at this Doge stuff are saying you're not saving shit. Nothing is being saved here. In fact, the cuts you've made have especially in the IRS and things like that, but the cuts you've made are causing drops in revenue that are going to offset any savings that you had with the cuts. So that doesn't work either. So the longer people have, it's just like any con, any con, they want to pressure people to close. They want to get people to sign the documents before everything unravels, and that's where he is now. He's got everything's unraveling, And so he's going to distract people with these riots. He's going to distract people with parades and do this and that. And it's all just to keep you from looking at what's really happening, which is they're trying to shove through a bill where the math makes no sense and the underlying premises are false. And he's got to get that signed. He's got to get it done. Once it's done, it's hard to undo. And even when the premise does fall apart, it's going to be like, oh, well, that's what we thought it was going to be. Sorry. So that's where we are. So we'll see. All we can do is watch and wait and see how it all unravels. So China puts, here you go. China puts a 6-month limit on rare earth export licenses. So they're, and this is because China, unlike the United States, China, when they make a deal, they do what they say. So if China gives you, if China says we're going to grant you a license, they grant you a license, and they're not going to change their mind or say, oh, he didn't play fair, blah, blah, blah. China's going to give you a license, it's a license. So the problem is they're giving 6-month licenses. That means they continue to have leverage and to be able to put pressure on us, because everybody who needs these rare earths, they can't, if it stops, it stops. There's no replacing China's supply. We're nowhere close at all. You saw MP's materials, pathetic amount of sales. It's not going to cover it. Nothing's going to cover it. And it will take years for the rest of the world to start mining a supply of rare earth to offset China. So China has everyone by the balls, especially us. And that's a disaster. And they can squeeze Trump anytime they want with this thing. So they're going to, same way we do the stupid budget bills where we do the debt ceiling 6 months at a time, that's what China's doing. We'll be right back to the table with China, having to give them concessions 6 months from now. Here's Musk is giving up already. Muted May inflation defies tariff fear. So yeah, because there is no tariff yet. When there is tariffs, if he puts them in place, that's when we're going to see what's going to happen. Here, revenue from duties jumped to 22 billion in May. 22 billion is $250 billion a year, not 600 billion a year that Trump is promising from tariffs, and that's the money that's being used, or actually I think more like 450 is being used in the Congressional Budget Office for their scoring in the big beautiful bill. So already you're 200 and something billion a year off. And how much is that? That's 2.5 trillion over the 10-year budget period. Or I'm sorry, it's 2.2 trillion over the 10-year budget period. Harvey Weinstein, holy cow. I didn't think he was still alive. Nobody talks about it anymore. So we have the big parade. I hope everybody's going to be there on Saturday with the birthday candles for Trump and all that. We got that going on. And we will see what happens. But right now it's a watching and waiting game. We've got plenty of stocks to buy. A lot of them are cheap. I don't mind building a portfolio of the cheap stocks that are on that list. Therefore, we have no pressure whatsoever to run in and buy things. We just want to buy things that make sense in an environment where it makes sense to buy them. And that's going to be our plan for the next few weeks. And it's not even a few weeks. It's going to go all the way through July earnings. And we're going to, and then the next earnings period, we're going to buy more stocks. We're always going to look for bargains and add, but you do it by, spend, we have, let's say we have space for 20 companies in the portfolio, right? We have 2 million of buying power. That's 20 $100,000 allocation blocks for purchasing. So we're looking to buy 20 companies, and if we buy 5 1/4, that's rushing it. It is, because you don't know. You buy the first 20, and if they do well, you buy you buy the first 5, and if they do well, you buy another 5, and if they don't do well, you got to fix the 5 that you bought before you buy another 5. And again, though, the way we buy stuff, if it does well, we're going to double and triple our investment. So if we take 25% of our portfolio to buy 5 stocks, and that doubles, then we're going to make 25% for the year already. But we don't wait until the end of the year. What we do is after 3 months, 6 months, we say, okay, we're on track and we're already up 30, 40%. And if we're up 30 and 40% and everything's going great, then of course we're going to buy 5 more and see how those go. But you know what? We're going to buy 5 more that are a bargain. We're not going to buy 5 more that got expensive. That's why it's great to have the watch list. We can always go shopping. We can always see what's going on. And believe me, when you have 200 stocks that you've got on your watch list, every earnings season, somebody goes on sale. Now, for good reasons or bad reasons, we'll see. Like I said, you look at things like IMAX, you look at things like RH, you look at Jack in the Box. Things go on sale for dumb reasons. And the question then you have to say is, well, will there be reasons for it to go up in the next 18 months? Or is it just going to stay down for a long time? Do they have to rebuild like Walgreens? Like Walgreens is on a big rebuilding cycle. And you know what's funny though? Today, they were talking about Walgreens buying more of Rite Aid. That's what got them in trouble in the first place. That's what started the whole downhill slide of Walgreens started because they tried to buy out Rite Aid, and they had a huge integration problem, and that destroyed the company. And now they're like, okay, let's buy the rest of it. Let's buy more Rite Aid. Let's buy another huge block of them. And it's nuts. But Walgreens also 7.8 times forward earnings. It's another one that's so undervalued right now. But wasn't on our, notice it was not on our list because we just got sick of them. They just cannot execute. It drives me nuts. All right, anyway, that's it for the voice. So we're gonna call it a day. Thank you everybody for coming. And next week is expirations. We'll be looking at our portfolios. How exciting. And I am pretty sure we're gonna have our portfolios done by Tuesday because we don't have many stocks in them. So that works out perfectly. All right, have a good day, folks. Thanks for coming.